JP Morgan opened 40,000 new accounts in the week following Silicon Valley Bank. In fact, the Friday that Silicon Valley Bank was still alive, but it was looking bad, that day, a representative from JP Morgan called us and said, hey, don't you want to change your banking to us?
In today's video, Mark Yusko, the founder, CEO and CIO of Morgan Creek Capital Management, discussed about the Fed raising interest rates and impact on all markets including crypto, the crypto bear market, and if we've hit the bottom on Bitcoin. Before listening to him, please ensure to smash the like button and subscribe to the channel.
A domino effect happened, and now we have a lot of banks getting exposed and with their balance sheets and the pain that they've been feeling from interest rate hikes and so forth. What is your take on that, and when do you see the end of this?
Yeah, so it's really interesting. You know, if you write the word crisis in Chinese, it's actually two characters, wei ji, and wei means danger, ji means opportunity. So yes, there's certainly a crisis, but in every crisis, you have the danger part, and we can talk about what that is in terms of the damage to the banking system and the collateral system. But there's also opportunity. And I think the opportunity here is quite robust. And I think we're seeing it particularly in Bitcoin, which despite a banking crisis and bank stocks collapsing as much as 100%, in some cases, Bitcoin went up 30%. So wait, what gives? Store of value, flight to safety. But let's talk about the banking crisis to begin with. So you got the first part, which is, all right, was there a systemic or systematic clamp down on banks that were friendly to crypto? Choke point 2.0, it's been called. Yeah, I think it's actually pretty clear, right? I mean, that's not supposition or hypothesis or pointing fingers at the big bad government. It looks pretty clear that there were certain banks that were targeted early on, Silvergate and Signature Bank to start. But then something kind of strange happened in that Silicon Valley Bank, which really you wouldn't consider a crypto bank. It's more of a tech bank, a bank that was used by a lot of founders to back their businesses, but also used by firms like ours, venture capital funds, to fund capital call lines of credit, and very large bank, very large business, huge growth market. And it got caught up in the second part of the crisis, which is this sudden realization. Now, why it's a sudden realization, I don't really understand, that these banks had unrealized losses on their government bond portfolios. And it all came to light, on the Wednesday, a couple weeks ago, 3 weeks ago, when, Silvergate had basically been crushed and put under. And Signature Bank was being crushed. And then there were some noises about some other crypto-related businesses. But Silicon Valley Bank basically had a little mini bank run. Some people withdrew some capital. So, the way a bank works is they have assets, which are our money, right? Us as depositors put our money in it. It's no longer ours. It's theirs. It's the bank's. And that becomes their asset. Then on the other side, they have a liability, meaning they have to pay us if we want our money back. And then the difference between the asset value and the liabilities is the equity of the bank. And so in a normal functioning market, that equity value is positive and it accretes over time as they invest the assets, either make new loans or in bonds, and then they pay depositors a lower amount. So if they pay depositors zero, which we had for about 10 years, and you can buy government bonds at 3%, awesome, 3% risk-free, you lever that up, make lots of money as a bank. Banks are supposed to take those assets and lend them out to other people and charge higher interest rates and then even make a bigger net NIM, net interest margin. Make a long story short, Silicon Valley Bank had this issue where some depositors took money out. So like, all right, we need to sell some of our assets and pay those depositors. Well, wait a second. Our assets went down in value because we bought government bonds. They raised interest rates. And so we have these unrealized losses. Well, now we're being forced to realize those losses. And they said, all right, well, we'll just issue some new stock to cover it. And everything was kind of fine. They had, $2.5 billion of new equity issuance to cover the $1.8 billion. And on a $200 billion asset, we're not talking a lot of pain, really a rounding error, is the money comes in. It doesn't get put in a vault and sit there. It gets lent out to other people, and then they deposit their portion, and then they lend it out again. And this fractional reserve banking system, I believe, creates wealth because you're putting money to work, increasing the velocity. But it requires confidence. It requires trust. It requires calm. Because if everybody comes in and says, I need my money, all of it right now, it goes away. So fomented this bank run. And the problem is, in the old days, we've all seen the picture. If you go to Wikipedia and look up Knickerbocker Trust, you'll see the iconic picture of a bank run. Guys in their suits and hats and the women in their dresses, and they're all carrying their umbrellas and they're running toward Knickerbocker Trust, which famously was taking share away from JP Morgan. And JP Morgan is quoted as saying, I like a little competition, but they were getting a little too big. So he spread a rumor that they didn't have any money, and everybody ran to the bank, tried to withdraw. They had to shut Knickerbocker Trust down. Just coincidentally, JP Morgan was there to pick up the pieces for pennies on the dollar.
Right.
And the rest is history, and JP Morgan dominates the banking system. So the same problem happened a bank, but the difference is, in the digital age, you don't have to put on your hat and drive to the bank and stand in line and wait for the teller to process your withdrawal. You hit a button.
Yep.
So $42 billion out of $200 billion. Now money vanished, got withdrawn. And now they're going to have to sell these assets that have unrealized losses. Well, that's the problem. So over the weekend, and it always happens over a weekend, right? This thing called the Committee on Economic Stability gets together every Sunday, and they've been doing that since 1988. It crashed in 87. And it's actually not a terrible idea, but it's a very small group of people: head of Secretary of the Treasury, the head of the Federal Reserve, the big banks, and they always decide what's going to happen. Well, the interesting thing 2 weeks ago Sunday was, yes, they said, all right, we're going to guarantee the deposits of Silicon Valley Bank, and we're going to allow Silicon Valley Bank to put those assets to the government at par. And everybody's up in arms saying, oh my gosh, that's terrible. They're only worth 80 cents on the dollar. Well, they're only worth 80 cents on the dollar if you have to sell right now.
Right.
If you can hold them to maturity, they're money good. These are government bonds. They're going to pay 100 cents on the dollar. So the government has a longer time horizon. They can do that. But what they did quietly was Signature Bank. Done.
Yeah.
Wait a minute. That's not a crypto bank. I mean, it has some crypto business, but it has a lot of real estate lending and traditional lending, and they shuttered that thing too. And nobody was talking about that. So that's a really long answer to say it started with this surgical strike against crypto-friendly banks. Well, why would they do that?
Mm-hmm.
Well, because the same reason that Silicon Valley Bank went under, where did all the deposits go? Right up to JP Morgan. JP Morgan opened 40,000 new accounts in the week following Silicon Valley Bank. In fact, the Friday that Silicon Valley Bank was still alive, but it was looking bad, that day, a representative from JP Morgan called us and said, hey, don't you want to change your banking to us? Like, what? You're circling the grave before it's even, cold? And crazy. So $120 billion left small and regional banks, went to the top 5 banks. That's bad. That's anti-competitive. That's bad for small businesses. Then what happened? Globally, this started to happen. You had $300 billion leave the European banking system. So suddenly Credit Suisse has a problem, gets to get merged into UBS. Mm-hmm. And so you had this global bank run starting. And again, banking only works when there's calm, because it requires us all to say, yes, I don't need all my money today. I don't want to put it in the mattress, because if I put it in my mattress and everybody knows that I put my money in where are they going to come to my house and take it? Yeah. So we go to a very dangerous place, hence crisis, if we start to lose confidence in banking. But I think, to answer your question, I think we're at the tail end, because the people, I would argue, who are behind this whole situation kind of got what they wanted. The money flowed up to the top, and now they are magically saying, well, you're a crypto business, you can come to us. We'll bank you. Well, wait a minute. 2 years ago, you said you wouldn't. Well, now suddenly maybe we will.